Gentlemen, it's my great pleasure to introduce the Honourable Joe Hockey MP, who is Shadow Treasurer. Joe Hockey was elected to Parliament in 1996 and he served in a number of important ministerial positions in the Howard government, for Minister for Financial Services and Regulation, then Small Business and Tourism, and he was Federal Minister for Employment and Workplace Relations. Had a number of other portfolio positions. He's going to talk about responding to the current recession, minimising risks and maximising opportunities. We're very pleased indeed that the Shadow Treasurer has agreed to speak to us this morning. Over to you.
Well, thank you very much, Alan, and congratulations. I'm sorry, Professor, and Dean as well. My goodness, all the titles, and to particularly to the school, congratulations on this initiative. And having served as a minister for 9 years and having worked in state government as well, I think it is so vitally important to have a very full and frank analysis of public sector activity and also to have innovative ideas about how to go forward. And regrettably, I haven't taken the opportunity today to talk a bit about that, but I would relish the opportunity to respond to questions in that regard. My talk today is about responding to the current recession. And right up front, I have to say that this illustrates the dangers of committing to a topic well in advance, because recent information suggests, of course, that the worst of the crisis is behind us. And that's a good thing. It looks increasingly likely that Australia has not entered into a recession. And certainly following yesterday's national accounts, which showed strong positive growth, given the economic circumstances, it is good news. But let me review the recent developments. The financial crisis is stabilising. Fear is receding and investors are becoming less risk-averse. Global equity markets have rebounded solidly since March. Corporate credit spreads to the government curve are appropriately narrowing, and there has been an improvement in credit flows. Term yields are now rising, and the Australian dollar has rebounded solidly from its lows of late 2008. The low was under 62 cents in November 2009. Now it's trading at around 83 cents. Bear in mind it was a parity, near parity with the US dollar prior to the crisis. So in fact Australia, with a flexible A dollar, has benefited significantly from that flexibility in its currency, and it's delivered great benefit to Australia at the appropriate time. The global downturn in the real economy also appears to be stabilising. Indeed, many countries have recorded positive growth in the June quarter of this year. So, contrary to what some have suggested, in fact, we're not alone. As a result, supranational organisations such as the IMF and the OECD have been upgrading their growth forecasts for the global economy. There is a growing view that the global growth recovery may be V-shaped rather than long and drawn out. And in July, the IMF revised up its forecast for world economic growth in 2010 by around 0.5%. Overnight, the IMF went further and indicated that there will be a further upward revision in its projections, which is good news. Even better news, one of the key symptoms of the crisis, falling residential house prices in the United States and in other countries such as the UK, now appear to be moderating, with signs that house prices are stabilising. And that's a good thing, obviously, stabilising rather than continuing to fall. And although the shocks to the global system did not eventuate in Australia, this country, of course, has been impacted. It is in the nature of globalised financial markets and economies that a shock in one part of the system will be transmitted to other parts. Having said that, the downturn in Australia now looks like being milder than expected, Indeed, it may be the case that even using the word recession to describe the economic slowing in Australia would be overplaying the point. In the June quarter, Australia recorded growth of 0.6%, and that followed 0.4% in March. It now appears that the downturn will certainly not be as severe as 1990-91, and perhaps even less severe than the Asian economic crisis of 2000. So that means that the forecasts for the immediate future in the budget of below trend growth for 3 years, followed by above trend growth in the financial year 2011-2012, may be pessimistic. Having said that, we still believe that the massive expectations of the out years are still optimistic. The main reason Australia is faring relatively better than our developed country peers is because we entered the downturn in far better shape from a fiscal and a monetary position. Bear this in mind, and you would expect me to say it, but it's real. Australia had economic growth of more than 4% when we entered into this downturn. We had unemployment of 4% when we entered into this downturn. Australia had, the Australian government had money in the bank of net $40 billion. Compare that with other countries that were entering into this downturn with higher unemployment, with governments already running debt to GDP of 40, 50, 60%. And bear in mind, some of those economies were already staggering. Secondly, the Australian financial system has been incredibly sound. Our top 4 banks have entered into the top 12 banks in the world. We didn't have an AIG or a Fannie Mae or a Freddie Mac or a Royal Bank of Scotland. We didn't have any of those. And one of the reasons why we didn't is because we undertook the Wallace reforms, which were very difficult. But we undertook those reforms during good times when it was absolutely necessary to do it. And I undertook, as Financial Services Minister, the reform of the Financial Services Act, Financial Services Reform Act, which was landmark legislation that helped to prevent Australia heading down the path of other countries. It also reflects the fact that Australia has been the beneficiary of the most generous terms of trade in years. As of today, the terms of trade are more favourable to this government than they were at any other time to the Howard government. The terms of trade today are more favourable than the day we lost government in 2007. And of course, the demand for our commodities, a significant issue in itself, continued as China ran a massive fiscal stimulus. And that was to our benefit because the purchasing, for example, of iron ore was at record prices. And it continued to flow through even into this year. And together with the floating exchange rate, where the A-dollar went from near parity with the US down to around 60 cents, it actually buffered us at the appropriate time from the economic downturn. So they are significant reasons to start with. And of course, and I'll say a bit more about it, the government's response. And we have questioned the government's response, and we have been consistent in that. The government responded to the global crisis by embarking on what we describe as a massive and, in parts, wasteful spending spree. This financial year, under this government, the ratio of government spending to GDP is forecast to be 28.6%, the highest since World War II, 28.6%. By the end of the forward estimates, June 2013, the ratio will be 26.4%. 26.4% in 2013. That is 2.5% higher than in the last year of the coalition government. We left them with 24% of GDP government expenditure. They've taken it up to over 28%, and in 4 years' time, they're still going to be a full 2.5% higher than when we lost government. And bear this in mind, the government has forecast that economic growth in 2013 will be strongly above trend. And this spending spree will last for a number of years. Since the 2008 budget, the government has made new additional policy decisions involving expenditure of $106 billion over the forward estimates. $106 billion of new additional expenditure since the 2008 budget. So when we talk about fiscal stimulus packages, and they might be referring to around $12 billion December last year and $42 billion earlier this year, it ignores the fact that the total amount of new expenditure initiatives since the 2008 budget is over $106 billion, and 40% of that is going to be spent after the 1st of July next year. After the 1st of July next year, 40% of the new additional expenditure kicks in. That's when interest rates are projected to be on the rise. And the problem is not just that the government's spending is extraordinarily large by Australian standards, it is also large on the international scale. OECD data shows that the Australian stimulus package was the third biggest of all OECD countries, with spending equivalent to 5.4% of GDP. Only the United States and Korea had larger packages, and they were in a far, far deeper situation. In terms of the balance between spending and tax cuts, Australia had the second highest reliance on spending at 4.1%, second only to Japan at 4.2% of GDP. Now, because of this massive spending program under Labor, the Australian fiscal position has sharply deteriorated. The government has delivered a fiscal policy which involves budget deficits from 2008 to at least 2013, 7 years of budget deficits, peak gross debt of $315 billion, and an annual bill of gross interest of $12.5 billion a year by 2013. So have no doubt, this is the biggest spending government since World War II. Our concern is that the trajectory continues. It continues to 2013, and we don't have any estimates beyond, because that's as far as it goes in the budget papers. What is the risk? The risk is that it appears, even though we are now having a much more mild than anticipated downturn, the government is not prepared to wind back its spending program. Continued emergency expenditure is just no longer required. We have repeatedly